when a company is at different stages of its growth cycle, you have to use different valuation metrics. Accounting is the language of business. And if you're going to be an investor in the stock market, the language of business ultimately dictates where stock prices head. Growing 100% per year is great, but if that 100% year is only for 1 year and that's immediately met with a minus 50%, I don't care about 100% growth at all. It's a sustainable growth rate that truly matters to me. You can be wrong a lot, but if you are occasionally right, the gains that you can get from your occasional home runs more than offset the losses that you pay for all the losers combined.
Welcome everybody back from the break. We're going to get started in just a second, but first, kind of a quick aside about this overall conference. One thing that we've really tried to do this year is represent, different timeframes and different styles, not just trading, swing trading, position trading, but kind of everybody. And our next speaker really exemplifies that. Brian Feroldi is an experienced investor, financial educator, author, and YouTuber. He's got an MBA in finance and has been investing since way back when in 2004. And we're really excited to have him speak and talk through, an introduction to financial statements, which could really expand our fundamental analysis capabilities. So, Brian, thank you so much for joining us, and it's great to have you.
Thank you, Richard. Thanks so much for having me. Hi, everybody. Yes, as Richard teed up, I am here to talk about a subject that I absolutely love that bores a lot of people, but that is financial statements and financial statement analysis. To me, if you can't pick stocks and you can't invest unless you know the language of business, and the language of business is accounting. So hopefully in my short little presentation here, I will give everybody an overview of the three financial statements, how they work, and I promise to do my best to make it as fun and entertaining as I possibly can. So first, let's talk about why learning how to analyze financial statements matters. I actually think that this can help you in multiple ways, not just investing. As I teed up, accounting is the language of business. And if you're going to be an investor in the stock market, the language of business ultimately dictates where stock prices head. So if you want to be able to analyze how a company is doing and make long-term predictions about where that company will be, you must understand accounting. It's an absolute critical skill. Two, if you can learn to master financial statements, you can ultimately become a better investor, not just a better investor in the stock market, but people invest in individual businesses, they invest in real estate. Learning how to analyze those separate businesses or real estate also involves financial statement analysis. The final thing that I'll point out is that learning to analyze financial statements can really help your own career. If you work for another company or an employer, especially a publicly traded company, you can really stand out in your organization if you can show other people that you are fluent in financial statements. I personally did that. I developed a reputation for myself back when I was in the working world at a 600-person company because I became known as the guy, not in accounting, that could actually read financial statements. So I think there are multiple ways that learning this skill can really pay off. So when it comes to teaching, I am a huge fan of this framework, which is IWBAT, which stands for I will be able to. My goal is that by the end of this talk, you will be able to identify each of the three financial statements and know what information they relay. So that to me would be a success at the end of my talk here. You can do those two things, identify them and know what information they relay. Here is a quick overview of where my talk will go over the next roughly 35 or 40 minutes. I'm going to have 5 minutes spent on each of these different sections, and we're going to end with some common Q&A and then some individual Q&A hosted by Richard. Okay, so here we go. There are three financial statements that all companies, all publicly traded companies produce. Those financial statements are called, number one, the balance sheet, number two, the income statement, and number three, the cash flow statement. All publicly traded companies are required by law to produce and report these three financial statements to their investors every 90 days, so 4 times per year. And these are in every way a report card for how businesses are doing. Now, if you're unfamiliar with these 3 statements so far, I have good news. You are actually highly familiar with all 3 of these statements. You're just used to them being called different things. So let's start with the balance sheet. A balance sheet is very similar to me asking you, hey, what's your net worth? If you have your net worth written down anywhere, that is your balance sheet. So when you think balance sheet, think my net worth. The second statement, the income statement, is also very familiar to if you've ever created a monthly or yearly budget for yourself. If you're running your household properly, you know how much money is coming in, how much money is going out, and how much you have at the end to save or invest. That is your monthly budget. So when you think income statement, think my monthly budget. The final one would be the cash flow statement, arguably the hardest of the 3 to master. But again, you are familiar with this. When you think cash flow statement, just think my checking account, my checking account. The cash flow statement simply measures how cash moves in and out of a checking account, a business's checking account, over a period of time. So those are the 3 financial statements, and each of them reviews a company's financials from a slightly different angle. And an important thing to know about all 3 statements is that they are all interrelated. And it's really through looking at how the 3 statements relate to each other that investors can get a more complete picture of a company's true financial position. Okay, so that's all 3 statements. Now we're going to go in detail, one each, and we're going to get more familiar with how they work. So we're going to start with the balance sheet. Well, let's start with this question. If I asked you, hey, what is your net worth? You would probably do this basic calculation. You would say, well, what are my assets? Everything that I own that has value. And then I subtract out my liabilities, everything I owe or people I owe money to. And the difference between those 2 would be my net worth, how much I am worth, at least on paper. Well, that same formula applies to a business. And we would use the balance sheet to assess a company's net worth. So we would take up what the company owns, their assets, subtract their liabilities, what they owe. But instead of calling it net worth, we call it shareholders' equity. That's all that fancy word means. It's basically how much is the company worth on paper. So while this is the formula that everybody here has in their head when they're figuring out their own net worth, there's a slight tweak to this formula that businesses use. Rather than liabilities being on the left side of the ledger, liabilities are moved over to the right side of the ledger. And notice the formula now. Assets equals liabilities plus shareholders' equity. And this is an equal sign for a reason. These 2 numbers, assets and liabilities plus shareholders' equity, must always exactly match each other. Hence the term balance sheet. All right, so let's take those one at a time. First, starting on the left side of the ledger, assets. That is what a company owns. And there are many different types of assets a company could own. That could certainly be cash that it has in its balance sheet. That could be inventory or products that are variable for sale. That could be long-term investments like buildings or manufacturing equipment. And it could also be an intangible, such as a company's brand name, for example. So those are assets. On the other side of the ledger, we have L, or liabilities. Those are all the bills that a company owes to creditors or to employees or to suppliers. So that could include expenses that are owed to insurance companies or employees. That could be debt, short-term debt or long-term debt that's owed to a bank, or it could be payables, things that are owed to suppliers of that business. The final number there is the E, or the equity, which is shareholders equity. Again, think of this as like company's actual net worth. And there are all kinds of terms in there that determine what a company is worth, at least on paper. Now, here is a common look at a balance sheet and some of the most common categories that you see. However, one thing that's noteworthy about all of these financial statements is that management teams have full discretion over how the terms are categorized. So no two balance sheets are exactly the same because each company makes them up themselves, but they all have to follow this basic pattern. So first, the first thing that is called out on the asset side is something called current assets. Current. Whenever you hear the word current, just think 1 year. So these are assets that the company owns that they expect to use within the next year. So that could be receivables. Money is owed to them by their customers. They expect to receive that money back in less than a year. Or inventory that they have in the warehouses, they expect to sell that in less than a year. So those are current assets. Right below that are long-term assets. And as the name suggests, those are things that benefit the company that are expected to have a useful life of longer than 1 year. So if this was your personal balance sheet, something like your house would be a long-term asset, something that you expect to live in and get use for longer than a year. So the word current just means 1 year or less. Long-term means 1 year or more. So that is assets. Let's flip over to the other side of the balance sheet. Next, we have liabilities, which is like assets, and that it's broken up into two main categories. First is current liabilities. There's that word current again. Those are bills that are expected to be paid off in less than 1 year. And then right below that would be long-term liabilities, which are bills that are expected to be paid off in longer than 1 year. So again, getting back to your personal life, a current liability would be something like your credit card statement that you're going to pay off at the end of this month. And a long-term liability would be a mortgage, which you expect to pay off over the course of 20 or 30 years, although hopefully it's much less for you. Finally, the final category is shareholders equity, which is again another name for the company's net worth, at least on paper. And there are various terms that are included in there for measuring that, but just know that shareholders equity roughly means a company's net worth on paper. Now, an important thing to understand about balance sheets is that they are a point in time snapshot of a company's current net worth. Now, think about that for a second. If you were to ask me what is my net worth, that would depend heavily on when you ask. I personally own a lot of stocks, and those stocks are constantly changing in value. So my net worth is moving continuously all the time based on market prices. Balance sheets work the same way. So they are a snapshot. It's a point in time picture that's typically done at the end of a given quarter. So every 90 days, roughly, a company takes a snapshot saying, here is our net worth at this specific point in time. And balance sheets are most useful when you actually look at several of them in a row because they allow you to assess how a company's net worth is changing over time. Now, companies are required by law to report their balance sheet 4 times per year in the United States. They typically do those at the end of each quarter, which are most commonly Q1, Q2, Q3, and Q4. And you can find that information by looking in SEC filings. The first 3 would be in a filing form called the 10Q, and the final one would be in the filing called the 10K. So that is a quick overview of the balance sheet. Moving on to the income statement. Again, this is very similar to me asking you, what is your monthly budget, right? Well, if I was to ask you that, you would take in, hey, how much income do we make in a month from salary, from dividends, from royalties, etc. And then from there, we subtract out all of our expenses. And the leftover amount would just be our savings rate, right? How much did we contribute to savings in that particular period? Well, if you were to ask a company that same question asked to a company, you would say, is this company profitable? You wouldn't ask for their budget. You'd want to know, is that company making a profit? But the formula is exactly the same. Revenue minus all of the company's expenses equals a profit, hopefully a good thing, or a loss, which would be a bad thing. Now, while we talked about a balance sheet is a point in time picture, it's a snapshot of one specific moment in time, the income statement is a lot more like a movie. There's a start time to it and there's an end time to it. And what the income statement is measuring all of the revenue and all of the expenses incurred during that specific period of time. So balance sheet, snapshot, point in time. Income statement, movie, period of time. So here is the typical layout of a common income statement. And just like the balance sheet, management teams do have discretion over how they present this data to investors. It has to broadly follow the steps that I'm going to lay out for you, but just know that some companies choose to provide more information than this, some choose to provide less than this. So starting at the top, most important thing to note about the income statement is the time period that you're looking at. Are you looking at a quarter? Are you looking at a year? And which year are you looking at in particular? So that's the very top. From there, we have the top line of the income statement, which is revenue, aka sales, aka how much revenue or sales did the company pull in during that period. From there, we go through a step-down manner to subtract out all of the various types of costs and expenses, aka expenditures, that a company has to deliver those products or services to customers. That could include things like cost of goods sold, which is actually cost to make the product, operating expenses, which include overhead, selling, general administrative, research and development expenses, etc. That could include non-operating expenses, such as interest expense, and as well as that dreaded beast, income taxes that you have to pay on any profits that you have. So revenue at the top, we subtract various expenses as we go down, and then we're left with the bottom line of the income statement, net income, aka profit, aka earnings. Net income, profit, earnings, all are synonyms that mean the exact same thing. Now, if we were talking about you and just your budget personally, we would be ending there. But since we're talking about companies and specifically publicly traded companies, we now have to go one step further. We have our profit, but we have to figure out how much profit is owned by each individual shareholder. So we take that net income and we divide by the number of shares that a company has outstanding. And in a company like Apple's case, for example, Apple is publicly traded and it has about 16.8 billion shares that are outstanding. So we would take that net income, we would divide by the shares that are outstanding. Boom, we get earnings per share, aka profit per share. And this is how much profit you are entitled to if you owned one share of stock. Now, an important thing to know about the income statement is that it uses a method of accounting called accrual accounting. Accrual accounting, a very key concept to understand if you're going to be doing financial statement analysis. What does that word mean, accrual accounting? Well, with accrual accounting, revenue and expenses are recorded in the period which they occur. They are not recorded when the payment is received or an expense is made. So that is a key thing to understand about accrual accounting. It uses what's called, you record income at the moment that you earn it, and you record an expense at the moment then you that it incurs. This is regardless of whether or not money changes hands at any given time. Now, to understand this concept a little more closely, I'm going to talk about a quick accrual concept that you are all familiar with, depreciation. So let's say you go out and you buy a brand new car and you pay cash for that car. And that car costs you $33,000. Now you own and you operate that car for a period of 10 years. And then at the end of 10 years, you sell that car for $3,000. So right away, $33,000 leaves your bank account. You operate this car for 10 years, and then 10 years later, you sell it, $3,000 enters your bank account. So here is what you, the individual, experienced from a cash perspective. You had a $33,000 outflow in year 1 and a $3,000 inflow in year 10. Well, that is cash accounting. And accrual accounting, the key thing to understand about accrual accounting is that revenue and expenses are recorded when they occur, not when payment is made or received. So when figuring out, is this company profitable or unprofitable, we don't use that $33,000 outflow and that $3,000 inflow. That's because the company actually would use the car for that entire 10-year period. And accrual accounting takes that lumpiness that comes with expenses and revenue, and it smooths it out to give investors a different view of profitability. So how would we do that with this car? Well, we had a $33,000 outflow, a $3,000 inflow, and it worked for 10 years. So accrual accounting, we would simply say that car cost us $3,000 to own, not to operate, just to own per year. So with accrual accounting, this is what it would look like on the income statement. We would simply subtract $3,000 as a depreciation expense over each period for 10 years to account for the accrual way of owning and operating that car. So that's a really key thing to understand about the income statement. It's kind of like an accountant's opinion about profits or losses during a period. It's regardless of whether cash came in or cash went out. It's an opinion of a company's profitability during that time due to that term accrual accounting. Okay, so that's the income statement. Now we're going to move on to probably the hardest of the three to understand, the cash flow statement. But just like the income statement, the cash flow statement is measured over a period of time. There's a start time and there's an end time to it. So again, balance sheet, picture, point in time, income statement and cash flow statement is a period of time. It's like a movie, start time and end time. So here is what the cash flow statement looks like. Just like all three statements, not every cash flow statement will look exactly like this. Management teams do have discretion to break these out, but these are the most common terms that you will see. And an easiest way to think of a cash flow statement would be, it's kind of like looking at changes in your bank account. The only thing that a cash flow statement cares about is, did money leave my bank account or did cash enter my bank account? That's it. That is the most important thing that a cash flow statement measures, and it's just like looking at a statement that you get from your bank. Now, the cash flow statement has three main sections to it. It's broken down into three main parts. At the top is called operating activities, and this is changes in the company's cash balance directly related to running and operating the business. Right below that is a category called investing activities, and this would be cash flow in changes from buying and selling assets that benefit the company. The third category is called financing activities, and this would be, how are we paying for those investing activities and those operating activities? Are we financing that with debt? Are we issuing debt? Are we paying off debt? Are we issuing stock? Are we paying off or buying back stock? And are we paying dividends to our shareholders? That is what the financing activities section accounts for. Now, a key thing to understand about the cash flow statement, unlike the income statement, which uses accrual accounting, the cash flow statement uses cash accounting. So as I previously said, the only thing the cash flow statement cares about is, did money come into my bank account or did money go out of my bank account? So cash accounting cares about, only counts revenue when it hits the bank account, and it only counts expenses when it leaves the bank account. That is diametrically opposed to accrual accounting, which only counts revenue when it's earned during the period which it's earned, and expenses during the period when it's incurred. So to visualize that, let's go back to that car analogy that we had before with the selling. So this, what you actually experience, that negative $33,000 followed by a $3,000 inflow from selling the car, that would be cash accounting. And that would be the accounting that's used on the cash flow statement. The measuring or the smoothing out of that expense over the 10-year period, that would be accrual accounting. And that is used on the income statement and the balance sheet. Now, what's so fascinating about the cash flow statement is that it actually, the very top number of the cash flow statement is net income, which just so happens to be the exact bottom number of the income statement. So that's just one example of how these statements are related to each other. Net income, the bottom of the income statement, is the very top number of the cash flow statement. So the cash flow statement starts with how much accounting profit did we make during that period, and then it adds back in other cash items that did not flow out of the business. And it does so in both operating activities as well as in investing and financing activities. So those cash inflows are accounted for in the cash flow statement, and the cash outflows are also accounted for on the cash flow statement. So you have a series of inflows and a series of outflows on the cash flow statement. And the end result of that, it's going to show you how much cash changed during the period that you're measuring. Did the company produce cash? Did cash balance go up? Or did the company consume cash and the cash balance went down? Now, once you have that change in cash over that period, we now can tell you how much cash the company now has. And that number goes directly onto the balance sheet to change the company's net worth. So again, showing how these financial statements relate to each other. So let's review. Balance sheet. The balance sheet, it shows you what a company owes and what it owns. It's very similar to your personal net worth. It is a point-in-time snapshot, and it uses accrual accounting. The income statement measures a company's income and expenses. It's most similar to your personal budget. It's measured over a period of time, and it also uses accrual accounting. And then finally is the cash flow statement. Its sole purpose is to track cash movements in and out of the business. It's most similar to your personal checking account. It's measured over a period of time, and it uses cash accounting. Well, I hope that you guys are still with me. You've made it through 2/3 of the presentation so far. Now we're going to move on to talking about GAAP versus non-GAAP earnings and how to find these financial statements. So great job, everybody, paying attention so far. So GAAP versus non-GAAP. Hopefully you've heard these terms before. And we're going to start with GAAP, which is simply an acronym that stands for Generally Accepted Accounting Principles. Generally Accepted Accounting Principles. What does that mean? They are simply a common set of accounting principles, standards, and procedures that all companies in the United States must follow, required by law, when creating financial statements. Now, that makes sense. It makes sense that there's a standard that all companies have to follow when they are creating financial statements. It would not make any sense for every company out there to come up with their own accounting system. So there are lots of benefits to GAAP accounting. Every company has to follow the same rules. You can easily compare one company to another or one period to another. You can easily verify that the accounting procedures are being followed, and they're generic. So there's lots of benefits to GAAP accounting, which has existed in the United States for about 100 years. Now, one flaw to GAAP accounting is that since it was created over 100 years ago, it was based on companies that were manufacturers. GAAP accounting makes a ton of sense if you have a factory and you produce something that is physically bought or sold by customers. However, we don't really live in that economy anymore. We live in the digital economy. And GAAP accounting does not really work well for modern digital companies. And that's because the rules of GAAP are black and white. They are absolute. But those rules don't always tell a complete picture to a company that was created in the last 10 or 20 years. Now, because of those limitations, those black and white limitations of GAAP accounting, another type of accounting has emerged, simply called non-GAAP, which just stands for not generally accepted accounting principles. Creative, right? So non-GAAP accounting gives management the flexibility to exclude at their discretion, quote unquote, one-time transactions. So GAAP is not non-GAAP. While GAAP is uniform, while GAAP is verifiable, while GAAP has clear rules and requirements, non-GAAP does not. And you might be saying, well, non-GAAP sounds terrible. Why would I want a company making up their own rules about what they should do and they shouldn't do? Well, here's a way to think about it. Pretend for a second that you were sending in your tax return to the IRS. It was your tax return year. And in this particular year, you had a house that you sold, and now you're choosing to rent. Well, if you were going to report, if you were going to be reporting this transaction to your investors, with GAAP accounting, you would absolutely have to say, well, this was your revenue for the year, and that would be the number that goes on your financial statements. But since selling a home and moving to a renter would be a one-time gain for you as the individual, it might make sense to exclude that number so that you can give investors a better idea of what your actual financials would be if it wasn't for that one-time transaction, right? You wouldn't want the IRS saying, well, you sold your house, therefore your income, your stated income is now $300,000 higher than it was the year before. You want to be like, well, no, my income is still that lower rate. I just happen to sell a house which artificially boosted it. So again, the rules of GAAP are black and white. They're very restrictive. So non-GAAP allows for a lot more flexibility. So broadly speaking, the benefits of GAAP accounting is that it's standardized, it's audited, companies are forced to include non-recurring charges as well as stock-based compensation, and they're also forced to include whether they had paper gains or losses on investments. Now, because of these forces, the profitability of a company under GAAP accounting usually looks worse because of the rules of GAAP accounting. Now, with non-GAAP accounting, which is not audited, which is not standardized, non-GAAP accounting almost always excludes one-time charges, it excludes stock-based compensation, and it excludes paper gains on losses. Because of these exclusions, the profitability of a company usually looks better. So I ask you, if you were a management team, which of these two would you tell your investors to focus on? The one that naturally makes your profits look worse, or the one that usually makes your profits look better? Well, that depends on the management team, of course, but you can hopefully understand why there are two different accounting styles, GAAP and non-GAAP, and why some companies, not all, some companies choose to report non-GAAP earnings in addition to their GAAP earnings, which are required by law. All right, so that's GAAP versus non-GAAP. Let's talk about how to find financial statements. How do we go about finding financial statements? I hope that you're all very familiar with this, but let's just make sure everyone's on the same page. First and foremost, the gold standard place to find financial statements is with the SEC's database. The SEC has the most accurate information on the information about publicly traded companies in the United States. So this is a go-to source for many people. Now, another place to go to get financial information would be the company's investor relations website. So you type in the company's name and then the words investor relations, and they also have very accurate information about a company's financial statements. Now, the third place to go, and the most popular, tends to be financial aggregators. And there are truly dozens of these available. But some of the ones that I personally like are Stratosphere and Ticker. And then there's also the most popular one in the world, which is Yahoo Finance. And these aggregators pull in financial data from thousands of companies and make it very easy to search and sort companies this way. The downside to using a financial aggregator is that the data isn't always 100% accurate or perfect. So it often can make sense to go directly to the source. So let me quickly show you how to do that using Walmart. So I'm going to go and show you step by step how to get Walmart's financial statements using the SEC's EDGAR database. So I simply go to Google or your search engine and type in SEC EDGAR database. And here's that website that comes up. And I'm going to be looking for Walmart, which is the ticker symbol WNT. So you type that into the search box and boom, here's what you see. Now, you probably noticed that this very much looks like a government website, meaning it's not intuitive to use at all, and you would be correct. So that is the downside to using the EDGAR database, is you kind of have to get used to it. But I'm specifically going to be looking at this section here, which is the 10K annual report and 10Q quarterly report. And I'm specifically going to be clicking the 10K, which is the most recent filing for Walmart. The 10K, the annual report for Walmart. Now, I can easily scroll down to click on one of these links to find financial statements, but a shortcut is if you click this little sections button up here. Look at that. There's a whole section here called financial statements, and there they are. And if I click one of them, I now have direct links to Walmart's consolidated statement of income, which just so happens to be what they call the income statement. So again, management teams have some discretion. So this is Walmart's income statement. Notice we have 3 years worth of reporting here. So this is the full year. We have revenue, and we have costs of that making that revenue. We have non-operating costs. Then we have income that the company made before taxes. Then we have how much income they actually made, how much net income that they made. So last year, Walmart made $11.68 billion. So these all numbers are in millions. So that's 11,000 million dollars. And then they had 2.7 billion shares outstanding, which gives the company earnings per share of $4.27. And if you keep scrolling down, you can get the other statements. This is the company's balance sheet where we see assets, current assets, long-term assets, liabilities, and more. And if you keep scrolling down, you can get the company's cash flow statement or statement of cash flow. So that's quickly how you look them up. The SEC database takes some getting used to, but it can be very useful for figuring out the company's financial picture. Very accurate too. All right, rounding out the end here. Thank you all so much for your attention. I'm going to answer a couple of common questions that I get about financial statements, and then we'll have Richard chime in to answer some of his own. So question number one is, what do I look at? Do I prefer GAAP or non-GAAP? Personally, it depends on the company that I am looking at. I always look at both, but I personally am okay with looking at non-GAAP numbers. Many investors are not okay with looking at non-GAAP numbers. But if the company is newer, if it's growing very fast, and it has very high stock-based compensation, I'm okay with using non-GAAP numbers. I think GAAP is a little bit too restrictive, but If in a perfect world, every company would report in GAAP, but that's just not the world we live in. So I am personally okay with using non-GAAP numbers. Number two, what are some financial statement yellow flags? Okay, I'm getting used to finding these statements. What am I looking for to tell if a company is in trouble? A couple of things that I'll throw out there is if a company has inconsistent revenue, if its revenue is not growing and heading in the right direction. Another one would be if it has a gross margin that is declining, heading in the wrong direction. That could be an indication that the company is having a lot of trouble selling its products to its customers. I would also be worried if I saw an upside down balance sheet. So a balance sheet with a lot of debt and very little cash. And the final thing I'll throw out there is a big divergence in a company's net income, its accrual profits, and a company's free cash flow, which is a measure of a company's cash profits. So if those two numbers are nowhere near each other, that to me is a yellow flag. Here's another one. What are some common mistakes that people make when they're looking at financial statements? Number one, believe it or not, is messing up the dates. So they're looking at the wrong date up top to make a decision. Another mistake is that I see investors make is they only look at and only think about earnings per share. They only look at net income, not realizing that net income uses accrual accounting. And I would personally emphasize cash accounting over accrual accounting because you can't spend an accountant's opinion, but you can spend cash. Another mistake I see people making is they're not looking at the dilution rate of the company, how many shares are being issued. They're not looking at free cash flow. They're only looking at earnings, and they're emphasizing some non-operating expenses, non-operating income or expenses. Those are mistakes that I see people making. Question number 4 is, should I pay attention to stock-based compensation? In this investor's opinion, absolutely you should. Stock-based compensation is a fact of life, especially for some of the most fastest, most dynamic growth companies today. Employees and management teams want to be paid in stock-based compensation. You should absolutely pay attention to it, and you should absolutely track it. But if you want to invest in some of the best businesses that are being created today, it's just an unfortunate reality that oftentimes you have to deal with very high stock-based compensation expenses. The final question I get is, what about valuation? Learning to understand valuation is a critical thing if you're going to be making investing decisions. And all 3 of the financial statements can be used to make valuation-based decisions. So valuation is very important, and a lot of the fundamental valuation work that's out there is directly related to the income statements that a company is producing. Well, thank you all so much for your time and your attention today. Again, my name is Brian Feroldi. I am very active on Twitter and on YouTube if you want to connect with me. If the idea of accounting interests you at all, I created a free ebook called 8 Accounting Terms Explained Simply if you want to continue your accounting learnings. And you can download a free copy of this ebook here by just going to my website, brianferoldi.com/accounting. So brianferoldi.com/accounting, and I will email you a copy of that book. And with that, thank you so much for your time and your attention.
Yeah, perfect, Brian, and thank you. And we'll have that link in the chat as well for people to access easily. Thank you so much for the excellent presentation. I know I personally learned a lot, and I think it helped. A lot of us traders like to trade the chart and not so much look at financial statements. So I think it helped a lot of people, widen, how they view companies. So thank you so much for that. I definitely do have a few questions. I see some as well. First things first, I'd like to ask, how many different quarters do you like to look at to determine a trend in any important metric that you're looking at?
Yep, the more the better. I mean, 2 years is better than 1, 3 years is better than 2, 5 years is better than 3, etc. If a company is newly public, you are often very limited in the amount of information that you have. If a company has been public for 30 or 40 years, it's very easy to see longer term trends. But it also depends on the stage of development that a company if a company is new to the public markets because it's only 5 or 10 years old, it's very often that those companies have some ugly looking financial statements because they're optimized for growth. That's what they're emphasizing. If a company is mature and it's been selling products profitably for for decades, I would expect that company's financial statements to be fairly clean. And you can really infer how a company has done in, say, recessions or down periods before. So more data is better than less, but I would say the last 5 years worth of data would be the most useful.
Yeah, that's helpful. And is there a certain kind of rate of growth that you like to look for, or it probably depends on the type of company, whether it's more mature, whether it's younger, whatever. But is there a certain rate of growth that you view as strong but also sustainable long term?
Yeah, the key thing is what you just said at the end: sustainable and long term. Growing 100% per year is great, but if that 100% year is only for 1 year and that's immediately met with a minus 50%, I don't care about 100% growth at all. It's a sustainable growth rate that truly matters to me. And the growth rate does matter, but if you're going to be making money on that from a fundamental perspective, the growth rate is one component of the amount that you should be willing to pay, but the other is what is the valuation that you're willing to pay. In general, generally speaking, the higher the valuation that I pay for a business, the higher the sustainable growth rate that I want to see in the company. And the inverse is also true. If a company is priced for essentially zero growth, then 5% growth is fantastic. If a company is priced for 40% growth, then 30% growth is a disaster. So it all depends on the stage that the company is in and the expectations built into it.
Yeah, perfect. And would you be able to kind of quantify what you look for to determine whether that growth could be sustainable long term? What do you kind of use to judge that? When you're analyzing a company that you're interested in.
Yep. So that is more qualitative than it is quantitative, right? So the things that I would think about is what is the nature of the relationship between the company and the customer? Is the company selling one-off items that once you have that item, you don't need another? Peloton, right? Think about a Peloton. You buy a Peloton for $4,000, then, or whatever the number is, and then you pay a monthly fee of $15-20 a month, whatever it is.
Right.
Peloton is getting recurring revenue from you, but that $4,000 expense, you are likely to not get that same customer spending $4,000 again, at least for several years, best case scenario. Conversely, if you are buying a software as a service company's tools that charges you, let's just say $50 a month or $100 a month, you're going to be paying that $100 a month essentially indefinitely. So as new customers come on, you can have a lot more confidence that that company's growth rate is actually sustainable because it's not a one-time sale. It's a repeat business, repeat purchase sale. The other thing I look at is who is the customer base? Is that customer base expanding because it's taking a part of a new trend? Is it stable or is it shrinking, which would be a bad thing? And then you look at the competitive position of the company. Is it a new industry that is creating hundreds or even thousands of companies that are going after it, like AI is today? It's really hard to assess the long-term growth rate of that kind of industry. But conversely, it's pretty obvious that Google won the search wars 15 years ago. So, and the company had such a dominant position, it was relatively easy to make predictions about that company's growth rate because you could say this company owns the search market, so it's going to grow at the same rate of the search market. So there's lots of qualitative, squishy things that you can look at to help you make an educated guess.
Yeah, that makes sense. You're basically trying to judge the stickiness of the product and the recurring revenue. That makes sense.
Yep.
And did you take a look at, I forget exactly what the metric is called, but the amount of increased spend per customer over the years? So, how much more they spend if, there's a new product that comes out, they also subscribe to that from the company. Did you take a look at that at all to kind of judge that sustainability stickiness?
Absolutely. That would be a term that companies are not required to report. Right. So it is something that is typically reported by, say, software as a service businesses. That has become the gold standard. That's called dollar-based net revenue retention rate, or DBNR. Right. So if a company reports that to you, absolutely, you should look at it. Another thing to do is when you're looking at the company's 10K, their annual report, do a search for the word churn or retention or something like that. Some companies do report to their investors what their customer churn rate is or what their customer attrition rate is. So if you can get your hands on that kind of information, fantastic. lots of companies do not report that at all, which makes sense because they don't necessarily have subscribers. Like Coca-Cola doesn't report its dollar-based net revenue retention rate for its soda drinkers. But some companies do report that, and if they do, absolutely look at it.
Yeah, and that's actually a question I was going to ask you, if there's any kind of key metrics that you look at that are outside of these statements. So, I know a lot of social media companies, they report, monthly users and something like that. So I guess it really depends on the company and the type of business, but maybe you talk through a few more kind of key metrics that might necessarily be reported in the GAAP earnings, but might be of interest for people who are more growth-minded, software as a service type companies. That's kind of a lot of the audience here, I would gather.
Yep. So as you said, it totally depends on the nature of the industry that the company is in. And every kind of industry has its own lingo that you need to get to know if you want to invest in that industry. So for software, there's things like remaining performance obligations, dollar-based net revenue retention rate, customer churn, annualized recurring revenue. These are just common terms that you have to know if you're going to invest in that industry. If you're investing in banks, you need to know things like net interest margin and efficiency ratio and return on equity. Right? Those are ways of measuring whether a bank is useful or not. If you're going to be investing in the beer industry, there's a term called depletions that you need to really understand and master. So it totally depends on the nature of the business. For social media companies, yes, they often the prices that those companies trade at are impacted drastically simply by the number of users or the number of user minutes that those companies experience on their platform. And that does not directly tie to revenue, but it can be an indication of the future trend of revenue. So yes, every industry, every company has its own metrics. Inside the 10K, the document, the annual report, there is a specific section called Management's Discussion and Analysis of Financial Conditions. It's like the worst branding ever, but that section is absolute gold, and you should totally read through it because that is essentially management telling you, here are the key metrics that we are managing the business towards.
Makes sense. Yeah. So I guess the lesson is depending on what industry you're really focused on, you got to learn, what the key metric is for that industry for sure. Taking a step back, just because I think it'll be useful for people to understand kind of where you're coming from. Could you talk a little bit about your background a little bit, and also the type of investments you like to look for, and the type of companies that you like to invest in?
Sure. My background is I graduated with a business degree in 2004 and had no idea what I wanted to do. I ended up joining a startup medical device company, which just sheer luck on my part eventually became publicly traded. Last I checked was worth $20 billion. So that worked out extremely well. I was in the sales and marketing team for them. And just on my own, for whatever reason, I just caught the investing bug. I just caught the I want to make money and become wealthy bug. And that caused me to research everything I could about personal finance, about money, about investing. I checked out real estate. I checked out small businesses. I checked out bonds. I checked out stock. I checked out all the different asset classes, and I determined that the stock market was the best fit for my personality. I really like the idea of buying assets that manage themselves. Right. I really like that aspect to them. I determined that my best investing style was long-term investor. And what I'm attempting to do is find businesses that I can buy today and hold for 5, 10, hopefully 20 years that internally generate funds and compound their cash flow at higher and higher rates and increase their market value over time. And the wonderful thing about investing the way that I do is you can be wrong a lot. Like I am, I'm wrong a lot. But if you are occasionally right, the gains that you can get from your occasional home runs more than offset the losses that you pay for all the losers combined. So I'm specifically looking for small, dynamic, high growth businesses that have a very bright future ahead. I try and fill my portfolio with them and hold on for your life.
And yeah, that's super helpful. Thank you. And is there a certain kind of market cap or industry focus, or you kind of keep it general and give yourself a lot of wiggle room there?
Yeah, so market cap is a key metric that I focus on. And the key thing that I'm really trying to ask myself when I'm making an investment isn't necessarily the absolute size of the market cap today. It's how big do I think the market cap could be in the future. The best case scenario is a company has let's say a $1 billion market cap today, and I could see that company having a 100 billion market cap down the road. So it's the absolute size difference on a percentage basis between where it is today and where I think it could be down the road. So for example, Apple has like a $3 trillion market cap today. Could Apple have a 10 trillion market cap someday? Maybe, like that's asking a lot, but maybe they could. If that's the case, then that would be a triple from today's price. That would be an outstanding outcome for Apple investors. However, $10 trillion is like an insane amount of, I mean, 3 trillion is an insane amount of money. So if you want to make a lot of money on a percentage basis, it's best to find companies that have much smaller market caps in them, because they have a much easier time multiplying than mega cap companies do.
Yeah, for sure. And I also wanted to ask you along those lines, because you talked about, the expected growth potential. Is there anything you look at to determine what the total addressable market could be in the future? Is it more, taking a step back, looking at the trends? How do you personally go about it and give an estimate? Obviously, it's never going to be perfect, but get a sense of what it could be 10 years down the line, 20 years down the line.
Yeah, thankfully that's what. So the TAM and the market cap are two different things. So TAM, total addressable market, is essentially a measure of how many customers are in this market times how much does the average customer spend in this market per year. So that is the revenue opportunity for a company that is going after. That kind of information is typically provided by the companies themselves in those SEC documents, and the companies don't always come up with those numbers themselves. They often outsource that to a third party to come up with those numbers. That's one way to do it, but keep in mind that's revenue. That's a revenue estimate. From there, if you want to do a market cap analysis, well, you can say, well, how much of this TAM could a company theoretically get? How much profit could the company get per customer? And then what would be the market value of that profit per customer? And do some math of that way. I think it's more helpful to just do rules of thumb and see to yourself, okay, if this company is worth $1 billion today and it has 200 million in revenue, given its market opportunity, is it ridiculous that this company could one day have $1 billion in revenue or $2 billion in revenue? Is there literally an opportunity for that? And from there, you can say, okay, if the company has 100 million in revenue today and could do 2 billion in revenue 10 years from now, it doesn't take a leap of imagination to be like the market cap could be 10 billion at that point.
Right. Makes sense. And we've talked a lot today, and you gave an excellent presentation kind of talking about, the quantitative side of things. But I'd love to hear, you touch on a little bit the qualitative side of things, addressing, what does the management look like, all those different factors. You and Brian Stoffel do an excellent job breaking down companies on your YouTube channel, which I highly recommend everybody check out who's watching. And you guys kind of have your own, series of metrics that you look for and scores that you give things. Could you touch on a little bit, the qualitative side of things that helps you get, a better sense of the company overall?
Yeah, absolutely. So here's something I would recommend everybody do, regardless of your investing style. So this is something that I do, and I would say it's so helpful. It's been so helpful to me. Make a list. Make 2 lists for yourself. List A, every single thing that I would look for in a potential attractive investment. For me personally, that's things like strong balance sheet, fast revenue growth, free cash flow, founder-led management team, recurring revenue, a stock that's already beaten the market, a history of outperforming expectations, etc. So make a big list. If a company if an investment has these things, good. Okay. Then make another list. If an investment has these things, bad. And for me, that is things like I hate customer concentration. So I don't like when one customer is an outsized portion of the company's revenue. I don't like it when a company is doling out tons of stock-based compensation. I don't like it when a company has antitrust risks, or when a company gets an overwhelming majority of its revenue outside of the United States and it has currency movements. I hate it when a company is dependent on a market price for sales. For example, I don't like oil companies, because oil companies depend on the price of oil to make revenue. And that is a factor that is completely out of management's control. So 2 lists, things you want, things you don't want. Then simply make a checklist for yourself and do some kind of simple scoring system. Checklists are such a cheat code for investing. So I have made a investing checklist for myself. Whenever I come across a company that might might interest me, I simply research it and check off my checklist as I go. The companies that meet the vast majority of the things that I'm looking for with the minimum number of points against them are the ones that I try to invest in, and the ones that fail my checklist, I avoid.
Yeah, perfect. And I think, like you said, that applies regardless of your investing or trading style, because you could do that for trading as well. You just look for more technical criteria while you, with your style, focus more on the story, the fundamentals, all of that. So yeah, I think that's excellent advice. One thing I do want to ask though, when you're considering, qualitative stuff and metrics or assessing the management, how do you eliminate bias or try to eliminate bias from your assessment? Because, people love a company, they're going to be naturally more more bent on accumulating or thinking, looking at things in a good light. So how do you try to eliminate bias to try to be as objective as possible in your analysis?
Yeah, the answer there would be to look at the numbers, to do the analysis, to keep myself to my checklist, and to be aware of the valuation at the time that I'm investing. So I'm the type of investor that if the valuation is more favorable, I try and buy more, and if the valuation is less favorable, I try and buy less. But man, there are so many investing biases and so many ways that your brain can screw up making investing decisions, and I've made so many investment decisions all along the way. However, the thing that I've learned the hard way is the more uncertain the future, the less I allocate to that investment, and the more certain, and I put certain in air quotes, the more certain I think the future is, the more I would allocate to that investment. So the risk of the business and the risk of the stock play a role in how much I allocate to that individual business. But when it comes to removing biases from your process, boy, is that hard. But it's infinitely harder if you're not aware of what the biases are and that they exist. So step one to me there is to study the investing biases that are out there. And once you learn about them, for me, it was like, yep, I've done that. Yep, I've done that. Yep, I've done that. It's like somebody psychoanalyzing your own brain. It's amazing.
Yeah, for sure. And another thing I wanted to ask you, and you touched on this a little bit already, is if there's a situation where a stock ticks off everything on your checklist or nearly every good thing, but the valuation is quite high, how do you handle that type of situation? And also, how do you usually arrive at that valuation? Are you using PE ratios, price over sales ratios? What do you kind of use to assess the valuation of a company?
Yeah. So the first thing let's say I love a company, right? I love everything about a company. The first thing I'm going to look at is its market cap. That would be the first check, and I'll see a market cap company. Let's say I find a company out there, like Snowflake, for example. When Snowflake came public a couple of years ago, I was like, wow, this company is growing insanely fast. Great founder-led management team. The financials were okay. Like, it was growing fast, but it was losing gobs of money. But Warren Buffett invested. The dollar-based net revenue retention rate, the DBNR, was one of the best numbers I'd ever seen in my life. And I was like, wow. This company is unbelievable. And then it came public at a $50 billion valuation. And then it shot up the day that, when I could actually become a shareholder, it was like $70 billion valuation. Right. So I asked myself, okay, this company's awesome. Do I think that this could be a $700 billion company someday? $700 billion. It was 70. So could I earn a 10x return on buying that company today? Well, at the time, the company's revenue was a couple $100 million, right? So you'd have to play forward 100% growth for like a decade for that to play out. So I thought to myself, this company is incredible, but at a $50 billion market cap and the insane valuation, I'm just not interested. I have a hard time seeing how I, the outside investor, win in that scenario. However, if that same company with that same number and those same growth rates came public at a $3 billion valuation, I would have been all over it regardless of the valuation, because it wouldn't take a leap of faith for me to say this could be a $50 billion company someday, but man, is it a big difference when it goes to being a $500 billion valuation to work out. So the valuation, I always think, what is the upside if this thesis plays out, and what is the downside if I'm wrong? And I try and stay as true to that as I can, knowing that I'm going to make a bazillion mistakes along the way. But I would rather be roughly, vaguely correct about that than absolutely wrong.
Yeah, perfect. And to the second question, what do you kind of use generally to assess what the valuation is? The PE ratio, PS ratio, or something else?
So this is one of the most tricky things that I've ever discovered about valuation. And that is this thing called the business growth cycle. So one common mistake that investors make when they're talking about valuation, myself included, is that they apply one valuation metric to all companies all the time, and they think that that is how valuation works. It's not. When a company is at different stages of its growth cycle, you have to use different valuation metrics. So when a company is in the startup or in the hyper growth phase, I think the most useful valuation metrics are total addressable market or price to sales. So they're in green on this. As a company matures and Abbott starts to generate profits, then other metrics like the price to earnings ratio, the reverse discounted cash flow model, the price to forward ratio, or the earnings yield, that's when they become useful. And in stage 4 and 5, that's when you have the most number of valuation metrics available to you. The hardest one is stage 6, when a company is in a permanent state of decline. That's when every valuation metric pretty much falls on its face, and you can't use valuation at all. That won't save you at all. But the big mistake that people make is they use, let's say, the price to earnings ratio when a company is in stage 2, and they make the wrong decision because the company is not optimized for earnings. So it's really important to understand, where is this company in the business development cycle, and which valuation metrics should you look at?
And it's interesting looking at that chart, which is really cool. There's the most opportunity when it's hardest to value a company, almost when it's early on in the life cycle. That's where the opportunity is. And when you get more mature, I personally, even though I'm a trader, I'm focused on stocks that are usually 1 to 3 years old, just because that's kind of where there's a lot of growth and where there's a lot of nice trends that I can ride. So I completely agree with that chart, and I think it's an important thing to remember that not all valuation metrics are created equal at different parts of the growth cycle.
In that startup phase, you have to think like a venture capitalist. The only thing venture capitalists care about is, what's the upside if I'm right? End of story, right? They can lose 100. They're expecting to lose 100% of their investment a lot, but that doesn't matter at all if they buy the next Google in its seed round, or they buy the next Microsoft in its seed round, or they buy the next Uber. That's the only thing they care about. So venture capitalists don't look at price to sales ratios, or price to earnings ratios, or price to free cash flow ratios. They don't do discounted cash flow models or reverse discount. The only thing they care about is total addressable market and what are how much money can I make if I'm right. Conversely, Michael Burry could care less about the total addressable market of a company. The only thing he cares about is, what is the valuation today? That's it. That is his lens. And he uses reverse discounted cash flow. He uses discounted cash flow. He uses price to earnings, and he only buys stocks when they're cheap. So there's no right or wrong way to do it. There's just the way that best matches your investing style.
I love that. And that fits. I completely agree. And I think that's perfect. One thing I did want to ask you as well, given your longer term perspective, do you take into account more the macro picture at all? What the Fed's doing, what interest rates are doing, or are you kind of solely focused on the businesses, the valuation, their statements, what they're doing today?
So the Fed, the macro absolutely matters. It has a huge impact on the short-term performance of my portfolio. However, I don't think that I can gain any edge over anybody by trying to better assess the macro environment than any other investor. I don't think I have any ability to do that. So what the Fed does completely matters to my portfolio, especially over the short term, but it's not something that I can personally forecast or think about, or think that I could get any edge over somebody. The only edge that I personally think that I have as an investor is time frame. Period. End of story. The only thing that I can do that professionals can't do is hold stocks for 5 or 10 years because I have no investors to report to. So that is my sole source of edge. I can buy a company and hold that company for a long period of time. That is an edge that the only edge that I believe that I have. I don't have better data. I can't do faster analysis, but I can hold stocks longer than everybody else. So when it comes to incorporating the macro, I very much look at that long-term chart, the 100+ year chart of the S&P 500 and say, what asset class outperforms? Stocks. Stocks outperform over long periods of time, regardless of what interest rate was, what macro conditions were, where there's a war going on or whatever. Stocks outperform. But in the short term, holy cow, can they be awful to own?
Gotcha. Yeah, it makes sense. I think that's definitely true. I don't have too many more questions. I did have one, but you read my mind and actually answered it before it. What were the kind of red flags, cautionary flags? You already answered that one. But I'll ask this one. What would be, a super green flag that you would notice in one of these statements? What would you take a look at and you're like, oh wow, I have to dive deeper into this company. This is changing how I'm viewing, what's going on with this name.
Yep, rapidly increasing margins. So gross margin, operating margin, net margin, significantly increasing over time. If you have margins all trending in the right direction, that is a hugely positive sign, in my opinion.
Makes sense. And is that regardless of the type of industry, or is that specific? Okay, cool.
Yeah,
cool.
I mean, different companies have different margin profiles, but I would say that is definitely a positive sign to see.
Perfect.
Especially when they go from negative to positive. That's a hugely positive development.
Is that shift something that you really pick up on and you dive deeper into companies that are making that kind of shift?
Yes. When a company goes from unprofitable to profitable, that is a monumental shift for the business. And the risk profile is dramatically lower when a company becomes profitable. So yes, trends in margins is something that I pay attention to.
Perfect. Another thing I want to ask you that's more on the qualitative side of things is obviously we've got the statements that are reported each quarter pretty much, but there's also the earnings call. So to dive deeper into that, one, did you take a listen to the earnings calls, which I would guess you do, and what additional color are you looking for in that call to expand on what the sheets show? And yeah, basically, how do you take into account what the ownership is saying about the business and how it's doing? How does that come into your analysis?
Yeah, so it totally depends on the nature of the business, the size of the business, and the scale of the business, and importantly, the short-term story about the business. So if I own a company, like one of my biggest positions is MasterCard. MasterCard is ridiculously profitable, ridiculously successful, ridiculously entrenched. It's ubiquitous. With a company like MasterCard, I glance at the quarterly financials and say, see you in 90 days. Revenue up, profits up, share count down, see you in 90 days. Like it's so quick that I look at that because that company is so entrenched. Conversely, a company like Tesla, I look over every single number. I listen to the conference call because the range of potential outcomes for that business is so wide. Plus, it's such an insanely fun company to follow. So how closely I pay attention to the company's financials at any given time really depends on the risk level of the business as well as how big the position is for me personally. So listening to the conference calls, you can absolutely glean a lot of information about a company. However, the maintenance work that you have to do in a company is far less unless there's a big unless like something thesis changing is happening at the company, unless there's like an existential risk. So for Google, more recently with AI, that perhaps is an existential risk that you need to do some more analysis on it that you need to do, say, 2 or 3 years ago.
Gotcha. Yeah, perfect. And you mentioned risk there. As an investor with a longer term horizon, how do you define risk in the markets personally, and what do you do to manage that risk?
Risk is Buffett's definition of risk is the best. The reasoned probability of permanent loss of capital, or even better, the reasoned probability of permanent loss of purchasing power is probably even more appropriate. So when I'm making an investment, to me, financial risk is the odds that that investment that I'm making don't pay off for me in the time frame I'm hoping that it pays off for me. Maybe the stock is permanently impaired and declines. Maybe the stock goes sideways for 10 years. To me, that's risk. How do I mitigate that? By continually adding to my portfolio. So that way I'm buying at different value points and at different stages of the business growth cycle. and two, by keeping my personal finances incredibly conservative. Zero debt, you own everything outright, huge emergency fund, multiple sources of income, high savings rate. That to me is how I protect myself from the crazy volatility of the market.
Yeah, perfect. And that's pretty much all the tough questions I've got for you. I've just got a few fun ones to wrap things up, Brian. This has really been really fantastic. First things first, do you have any favorite investing quotes or quotes that might not be explicitly about investing, but relate really well to the markets?
Ben Graham's quote is my favorite ever. In the short term, the market is a voting machine. In the long term, it's a weighing machine. That's my favorite investing quote ever. I'm a huge quote fan. I throw one a week in my in my newsletter, but that's the one that comes to mind.
And can you expand on that? How do you personally interpret that quote? What does that mean to you?
Yep. So in the short term, the market is an ongoing live auction. And the only things that matters in the short term is the near-term demand imbalance between buyers and sellers. If the demand for a stock is high and there's more buyers and there's more enthusiastic buyers than there are sellers, the price is going to go up. If the demand for a stock is way down, nobody wants to invest, and there's a lot of selling pressure, that stock is going to go down. That is what rules the short-term price movements of stocks. But in the long term, what rules is the fundamentals of the stock. How much revenue does the company have? What is the company's profitability? What is the company's long-term growth prospects? What is the inside ownership of the company? So the income statement, balance sheet, and cash flow statement, they rule the long term. In the short term, the mob's mentality rules.
Gotcha. Perfect. Any other quotes that you want to throw out there, or just leave it at that golden one?
I will throw up the one that's on my wall. I don't know if you can see it there, but
yeah, it's out of focus a little bit, so I don't.
Yeah,
you might have to read it.
Investment in knowledge pays the best interest by Ben Franklin.
I love that. Yep, big fan of that one. Perfect. My other kind of fun question is, do you have any book recommendations for people out there who want to dive deeper into fundamental analysis in general? And just want to learn more about the investing time frame.
Sure. So I'll plug my book, of course, which is Why Does the Stock Market Go Up? It's all about the fundamentals of investing in the stock market. But the other one that I will plug, I don't have right behind me. It must be over there. But it's Warren Buffett and the Interpretation of Financial Statements. Warren Buffett and the Interpretation of Financial Statements by Mary Buffett, Warren Buffett's former daughter-in-law. It's an excellent look at a page-by-page analysis of all three financial statements as seen through the eyes of Warren Buffett. It's really great if you want to master fundamental analysis.
Perfect. Well, Brian, as I mentioned, I really enjoyed this. I think it offers something different than the rest of the conference. So thank you so much for taking the time to speak here. You already mentioned your newsletter. Where else, and you can plug that again, where else can people learn more about you and your style and just connect with you if they want to learn more?
Yep, the best way to connect with me is on Twitter. I'm at Brian Feroldi, or if you're interested in learning more about my newsletter, it's at brianferoldi.com/newsletter.
Perfect. Well, Brian, I think that's our time for today. Once again, thank you so much for being a speaker. I really enjoyed this one. It looks like a lot of people did as well. If you're watching and did enjoy, please go ahead and leave a like down below. We'd really appreciate it. Definitely go ahead and check out Brian on Twitter. Definitely, if you're a longer term focus, he'll be extremely helpful. So thanks so much, Brian.